I get asked all the time, what do you believe is the best opportunity right now in the stock market? And it's really hard for me to answer this question because anything outside of memory, anything outside of semiconductors hasn't really done too well. If you had any stocks, non-semi, non-memory, you haven't done much this year, and there's so many opportunities outside the semiconductor space that it's really hard to pinpoint to one opportunity or one sector or one stock. But I'm gonna do that in today's video. I'm gonna tell you what I believe is the best risk to reward setup in the market. And I actually can't believe I'm saying this, but it is the Magnificent Seven stocks. Now, if you go back a year or 2 years ago, the sentiment on those stocks was highly euphoric. I used to see videos on YouTube on why big tech keeps on winning, and people telling me, why would you go and pick small caps and pick all these stocks? You could have just bought Google or just bought Meta, just bought big tech and outperformed everything. Well, the sentiment right now couldn't be worse on the Magnificent Seven, and people believe this time is different due to capex spending, but I don't believe this time is different, and I'm gonna tell you why. Now, those stocks have massively underperformed the S&P 500. The S&P is up 8.5%. The Magnificent 7 ETF, MAX, is down about 4%. And some stocks like Microsoft are down 15 to 20% year to date. And I posted this chart on X. It says you have 12 months, or you have 12 months left to buy the Magnificent 7 before the cash flow explosion begin. And if you want to know how bad the sentiment is on the Big 7, just go read the comments. You'll be mind blown on how bearish people are on the Magnificent 7. And if you compare it to a year or two ago, I mean, it's absolutely laughable how price action drives sentiment in the market. But I think it was a highly misunderstood chart. Now, the chart showcases that 2027 will be the trough, will be the bottom in free cash flow. And after 2027, free cash flow is going to explode for all the Magnificent 7 stocks. And I got a lot of comments making fun of me, telling me, has anyone ever heard of maintenance capex? You can't just build a 1 trillion of infrastructure and then stop paying the bill. And this is the biggest misunderstanding that people have, which is the difference between maintenance capex, gross capex, and the business model of those companies in general. Now, if you look at Google, Google has reported earnings yesterday. It has reported its first ever negative quarter in free cash flow, or the first over the last 10 or 15 years. This is really bad. Now, why did they report negative free cash flow on the quarter? It was mainly due to massive capex spending. The company posted $39 billion in cash from operations. Their capex was $45 billion, much more than their cash from operations, so they ended up with negative $5 billion. Now, most people believe that all of this capex is maintenance capex, which means those stocks have to keep spending it and they can't cut it back, they can't slow it down, they have to keep spending it on capex. But I think most of this $45 billion is not really maintenance capex. A lot of it, in my opinion, is gross capex, which could be cut back anytime. Now, if you look at the business model of Google, most of it doesn't require $45 billion a quarter in maintenance capex. This is about almost $200 billion a year. Google search doesn't require $200 billion a year in maintenance capex. It's just a very efficient business, very profitable, high margin. It's here, it's been developed, and it's not going anywhere. That's not going to require $200 billion in maintenance capex. YouTube requires very little capex. I'm the one making content for YouTube, and YouTube is getting paid without doing too much. YouTube doesn't require $200 billion in maintenance capex. Same thing with the Google ad business. Same thing with Google Play. Google Cloud is the one that's capex heavy, but I think anyone would be foolish to believe that Google Cloud requires $200 billion a year just to survive. There's no way. If I had to bet, I would bet 40-50 billion in maintenance capex, but the gross capex is about 150 billion, which means Google is unprofitable on a cash flow basis by choice because they're spending a lot of it on gross capex, not maintenance capex, and you have a lot of them started to make their own chips, so the cost of those chips will decline over time, the memory stuff will be resolved, and the maintenance capex will be much less, and those companies could be very profitable on a free cash flow per share basis. Now, the misunderstandings that people had with my chart is mainly around, spending on capex. Like, people believe they will stop paying the bills, or they will stop spending on AI capex. But this is not what this chart is highlighting. This chart is highlighting that the pace of the increases in capex spending will peak this year. And we've had capex from those companies increase by about 85 to 95% year over year. So the pace of the capex has been increasing like never before. What a lot of people are betting on, and the analysts are betting on, is that the pace of the increase will peak this year at 95% growth, and it will start to slow down. It doesn't mean that those companies will stop spending on AI or they will stop spending on capex in general, but the pace of the increase year over year, we have likely seen the peak of it, and it will start to decelerate from here, which I believe could cause the market to give Google and Amazon and Meta and a lot of them a massive re-rating in their multiples. And there's a few reasons why I believe capex, the pace of capex increase, is peaking this year. One of them is the companies are running out of money. Like, Google is posting negative free cash flow. Other hyperscaler and the big seven are all expected to pretty much turn negative in free cash flow in late 2026 to early 2027. So they already went through the cash from operations. Free cash flow is negative. Google is running the balance sheet like crazy. They had very little debt, about 38 billion last year. This year, they have $155 billion in debt. So their free cash flow negative. They have 150 billion in debt. They raised equity. They're diluting stock. After buying back stocks, they're diluting stock to spend on capex. What is left? Where is Google going to get the money from? Are they going to keep just raising money and killing the stock? That's going to upset a lot of people, shareholders, the managers. That's not really sustainable. So if you look at a lot of those companies like Amazon and Meta and all of them, they pretty much did everything. They spent all their cash from operations. Their free cash flow is negative. They ran up the balance sheet, and they're doing equity raises. Like, there's really not much room left, for example, for Google to double capex again to $400 billion next year. This is pretty much unsustainable. So what I'm betting on, and what some people are betting on, is that we've seen a peak in capex growth, and those companies will keep spending on capex, but the pace of this capex growth will decline, which should cause a massive change in sentiment in a lot of those stocks. And once the change in sentiment happens and people say that, okay, we've seen peak capex growth, now it's going to be less and less from here, then the market will wake up to Google's 24% revenue growth, 70% in search, 82% in the cloud. I mean, was an amazing, amazing report. But the market sold it off 7% from fears of more capex spend. But once the market reached some certainty on peak capex growth, then, the trend is lower and lower from here, because those companies are getting maxed out on the balance sheet, equity raises, no more cash flow left. I mean, to me, that looks like we're pretty much nearing the end of this growth. But there's another reason why we could potentially be nearing the end of the massive, crazy capex spending, is if we have any kind of a change in administration in 2028. And some people even argue that the reason why a lot of those companies are spending so much on capex right now is because they're fearful that we might have a different administration in 2028. They're no longer going to be able to build all the data centers and build a power plant, buy the data center. That was unheard of a few years ago. So they have a golden opportunity, and maybe they're going all in before they believe it could potentially be too late. You have a very bad sentiment on AI in the United States, not just from democratic states like New York, which banned data centers, but even in Florida, the governor is not a big fan of data centers, and he believes they create no jobs and they consume a lot of energy. So people in the United States in general, they're not big fans of data centers. They're not big fans of AI because they're scared AI will take their jobs. We don't have any AI regulations and all of that. So if there's more restriction under a different administration in 2028, and we can no longer just keep building those data centers and do all these things, then, those companies will be forced to not spend as much on capex. And I believe all of this could potentially come together over the next year and a half, creating a massive opportunity in the Magnificent Seven. And the market is forward looking. So I'm not sure for how long this is going to last. But my last example is going to be Amazon. And it's an amazing example because Amazon has been growing cash from operations like crazy from 85 billion, 150 billion. Last year, it was $140 billion. And it also grew their capex spend to $131 billion. If you also look at the Amazon business, Amazon online store does not require $130 billion. The physical stores require, I don't know, maybe 20 billion, 50 billion. I mean, you could look at Walmart, it's not $130 billion. Third party is like very low on capex. It's an amazingly high profitable business. Advertising, little to no capex. Subscription, very little capex. AWS requires capex. But I'm willing to bet that not all of the 140 billion is all maintenance capex. A lot of it is gross capex that could be cut back anytime. But let's assume that my thesis is right. And Amazon doesn't cut capex. They just spend a little bit less. So they don't take it from 82 to 130 to 200 billion to 400 billion. They just kind of maintain it around the current 2026 level. If they can just maintain it or slightly grow it and expand cash from operations at such pace, the company is going to be extremely profitable. They're not going to be falling behind in AI because they will still be spending on AI, but they would have much more profitability and free cash flow would explode like I showed you here in this chart. So it's not about those companies not paying their bills. It's more about slowing the pace of the increase of capex while cash from operations are skyrocketing as they're seeing a lot of the backlog turn into revenues and all these things are happening, and the free cash flow would skyrocket mainly because there's no free cash flow, it's negative. They're loading up the balance sheet and they already did equity raises. So it's all those things are signs that we're nearing the end. And if we have any change of administration in 2028, there will be more restrictions and those companies will be forced not to spend as much on capex. So this is my video on the big seven and the hyperscalers and why I believe, it's representing a pretty amazing opportunity. So that's my opinion. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.